Hi, this is Ed again from Wise Up. This time we're going to be looking at credit cards. The sort of pros, the cons. I guess a lot of people come with a sort of preconception of credit cards and whether they are useful and things to be used and enjoyed, or whether they're things that people try and avoid at all costs. Now, whatever your preconceptions are, and some of you will definitely be in the first camp that thinks credit cards are bad because you don't particularly trust yourself maybe with debt, or maybe you've been told by parents or siblings that, or maybe you've even heard some horror stories from parents and siblings about their experiences with credit cards. Or maybe you're on completely the other side of the spectrum and you think credit cards are really good and you're probably not going to be able to survive without them. What we hope is that we're going to give you enough information for you to make up your own mind. Now, you will not be receiving a credit card until your 18th birthday at a minimum, but after that you potentially will be inundated with lots and lots of offers to take out new credit cards. So we'll be going through today what they are and also how they work. We'll be looking at the difference between direct debits and standing orders and how you use those effectively when you're managing your credit card debt, and also what the benefits are and some top tips before you get involved. Okay, so before we go any further though, we're going to do a little activity to match words to definitions. Now, all of these words will be cropping up when you're looking at credit card and debt in general. So it's quite a good idea to have a good working knowledge of what they all mean. So first of all, annual percentage rate. That is the cost of using credit expressed as a yearly rate. Now, whatever loan you might be looking to take out, you will always see that there is an APR attached to it. It's there really so that we can compare different loans to each other using the same basis, this annual rate. Second one, monthly interest. That's the cost of using credit expressed as a monthly rate. Now, you will be charged interest on your credit that you do not pay back, so the balance on your credit card that you do not pay back, but that will be charged at an APR, but that will not be the same as the monthly rate because you will be charged interest every month and you would not be charged the APR because the APR is an annual percentage rate. So it's the APR expressed as a monthly rate. Third one down, your balance is the amount that's left to be paid after the initial repayment, and it's the balance that has the interest applied to it. All of these things, don't worry, we'll be working these through as we go through the section. If you are late with your payment, you can expect to pay a late payment fee. So that's a penalty that's added on to your overall balance. So it will increase the amount of money you owe if you are late making a payment. That's only half the story though, because you will also suffer with a downgrading of your credit score. And we will be looking at credit scores in a separate section as well. So I would urge you to have a look at those after this particular one. Next one, a minimum repayment. Now, every credit card you take out, you will have to pay a minimum repayment every month. And that minimum repayment will vary with the particular card that you've got, but also on the balance that you owe. So as your balance goes down, your minimum payment will go down as well. Now, on the face of it, that actually looks like a good thing. You'll have more disposable income if you have to repay less. But when we start to look into it a little bit more, if you pay less back every month, it means the amount of time that you're going to have your debt will increase. And if the amount of time you have your debt increases, it means you will have more interest applied to it, which means that the credit card company will make more money and you will end up paying more for your debt than you would do if you paid it back earlier. So although this minimum payment that goes down along with your balance looks like a positive thing, and indeed it might even be sold to you as a positive thing by the credit card company, I would urge you not to think of it in that way. Next one is an overdraft. And an overdraft is just an added credit amount to your bank account. Now, you may already be familiar with the idea of an overdraft. It will be a certain amount of money, of the bank's money, that you can spend over and above what you have in your account. You will have to pay a fee for that, and you will have to pay interest on your overdraft as well. And finally, a grace period, which is the number of days which you have to pay your bill without incurring fees. So when you buy something on your credit card, if you buy that soon after your last bill was issued, you could have 30 days interest free before you have to pay anything back on that balance. All of this will become a lot clearer as we go through a couple of examples when we get into the actual session. Okay, so those words are all words that will crop up as we go through. So we're going to start off with, what is a credit card? Well, credit cards like debit cards, but instead of spending your own money, which you've got saved up in your account, you are spending somebody else's money. It's the credit card issuer's money. So like any money that you spend that isn't yours, you will have to pay interest on the amount you spend and don't repay. Now, every credit card will have a credit limit on there, and that credit limit can change even without you asking. Now, your circumstances could be that you've only just got your very first credit card, which you would expect then to have a pretty low credit limit. But provided you use that credit limit quite well, you'll find that that is increased, maybe even above the level that you're comfortable with. So please don't just assume that because you're given a bigger credit limit, you have to use it. You can actually ask the credit card company to reduce it back to a level that you're happy with. So you are in control of your credit, not the credit card company. Now, we've already mentioned this APR, the interest element. That's applied to any money that you owe. So when your statement comes out, you will be asked to make a minimum payment, or indeed you can pay the entire amount off. If you pay the entire amount of the credit card balance off, you will have no interest to pay. But if you pay an amount up to, but not including the full balance, then you'll be charged interest on the remainder of the credit balance that you have left after you've made your repayment. I hope that's fairly clear. I'm going to give you an example in a minute, so I think that will work out quite well for you in the end. Then there are many different types of credit card supplier. Not all of them are from banks. You'll probably notice now that Amazon do credit cards, Sainsbury's do credit cards, lots and lots of companies that you wouldn't necessarily associate with financial products now offer credit cards as well. So be prepared for lots and lots of people trying to get you to take up one of their credit cards. And the other thing with credit cards, whereas with a debit card you will just have one which is linked to your current account, you can have multiple credit cards. So you are in control. I would suggest though that you keep it to one or two. Don't have multiple, because debt can very quickly spiral and start running away with you. So it makes sense just to use one sensibly. Okay, so how do credit cards work? Well, as I said, you will not get a credit card until you're 18, but as soon as you apply for one, your background will be investigated, and then a small credit limit will be given to you along with your credit card. Now, the credit limit is the maximum amount that you are allowed to spend on the card. So if you then decide to buy a certain amount of stuff with your credit limit, and then you pay it back in full at the end of the month, so if you bought something for £150, you paid the entire £150 back when your bill came in, no interest would be applied, and you're back to the full credit limit again at the beginning of the next month. Or you could choose not to pay the whole amount back, but pay a partial amount back. So for example, if you bought something for £150 and you decided to spend £50 to pay back your debt, you'd still have £100 that was outstanding, and the interest would be applied to that £100. which means that your limit next month would be whatever your credit limit was, less the £100, less the amount of interest that was also applied to it. So what I'd like you to think about here is, if you have a card with a £300 limit, you spend £100 on the card, and then at the end of the month you pay it back in full, how much interest would you owe? Well, hopefully from what we've just spoken about, you agree with me that there would be no interest applicable. Therefore, what would your credit limit be for the next month? Well, it should be back to £300 again. Now, the other option was you have your card with £300 limit, you spend £100 and you only pay back £50 at the end of the month. How much interest would you have to pay, or what would that be applied to? Well, it would be applied to the £50 that you did not pay back. So if we take off 1/12 of whatever the APR is on £50, then it will come to roughly about £1. So your balance then for the beginning of the next month will be £249. So you started with 300, you spent 100, you paid back 50, so it would appear as though you got £250 credit limit, but then we have to apply the £1 interest as well. And whilst we're using very small numbers there, obviously these things can move up quite quickly, so your interest can actually ratchet up quite quickly as well. So just be very careful of the interest element. Right, so let's say that we go down the second route there where we don't pay the full balance back. What are our options when we get to that stage? Well, remember now we have £249 that we have as our credit limit. What can we do then? Well, we could spend nothing at all, which means that we have an option to pay back the whole balance, £51 in full at the end of the month, which means we have no balance outstanding. We're back to our £300 limit again. We could also pay back the minimum amount required by the credit card provider. That's one of our other options. Or we can pay something back between the full amount and the minimum amount, and we're in control of that. We will of course then be charged interest on the amount that we do not pay back, and that will be added to the balance of the card. So let's look at managing the account well. So we have money that's been spent on the credit card. As we've outlined just now, we have an option to pay that back in full. We can do that in two ways. We can wait till our bill arrives and then pay that back manually, either using an electronic payment or a cheque. Or we could also set up a direct debit, which will enable us to pay back the amount in full. So we instruct the credit card company that our direct debit should always be for the full amount every month. If we do that, of course, we have no interest charge, and because we're doing something with it using a direct debit, it means we're absolutely safe and we're not going to miss that payment. Okay, so that's one way we can actually manage our account, by paying everything back in full. We can also pay back a minimum or a custom amount every month. Now again, we can use our direct debit as being one of the methods to do that. This time we would set up a direct debit with the instruction that the credit card company takes back the minimum payment every month. Or we can ignore the direct debit altogether and decide to pay a custom amount back every month using a standing order. Now I'm going to explain standing orders and direct debits to you at the end of this particular slide, just so that we're all very clear about the differences between the two. Now if we use either a direct debit or a standing order, again it ensures that we never miss any payments, so it's very secure from that point of view. So let's have a look at the differences then between a direct debit and a standing order. Both of these are ways to pay amounts of money to a third party. And it's an instruction that goes via our bank. Now with a direct debit, we allow a provider, somebody who we're taking a service from, to charge a variable sum to our bank account. Now provided we've got enough money in our account to cover it, our bank will pay it on our behalf. We don't get involved at all other than setting up the direct debit originally. This is really helpful when we're paying household bills that vary in amounts, especially when we have a mobile phone bill which has a different amount going through potentially every month. Direct debit's probably the most common way to make payments, and they will always work when you have enough funds in your account. If you don't have enough funds in your account, the direct debit will not be paid unless you've already got an overdraft facility in place. And if it's not paid, then you will incur fees for late payments. Very easy to set up, but remember, it's the third party, the provider, that is going to be coming to your bank to ask for the money. It is not you that is initiating the payment other than setting up the direct debit. Okay, so with a standing order, you're much more in control. You pay the same amount to the provider on the same date each month. Now this amount is in your control, so if you want to change that anytime, you can do that through your banking app, or you can go online and do it through your online account. It's used for regular payments, so things like mortgage repayments, loans, budgeting pots, savings accounts, things like that. And it always works when you have enough funds in your account or you have an overdraft to cover the extra cash. When you set those things up, you will need the bank details of the person or the company that you will be paying, their name, their account number and their sort code number as well. So those 3 bits of information will be necessary for you to set up a standing order. But again, I'll reiterate, you are completely in control. Now these 2 different methods of payments makes a big difference when it comes to working with your credit card successfully and comfortably. Let's look at a little example. Let's say that we have a credit card with a balance of £500 on there. This particular credit card has a 20% APR. The minimum repayment terms are either 1% of the outstanding balance plus interest, 2.25% of the balance, or £5 flat, whichever is the highest. Now remember, our minimum repayment will be going down with our balance. So that means although 1% of our balance plus interest might start off as being the most, at some point it will be superseded by 2.25% of the balance, and at some point that will be superseded by £5. So looking at this very first example, what will the minimum repayment be if we have minimum repayment terms, which I've just outlined there, and we have a balance left over of £500? You can pause the video here just to let you work these things out. Okay, so let me explain these for you. So if we take 1% of the balance plus interest, that is £5 as 1% of the balance, and then interest 20% APR for 1 month, which is £13.33. 2.25% of the balance would be £11.25, so 2.25% of £500, or of course, straight £5. Our minimum repayment is whichever is the greatest out of those 3. So on this particular example, it would be £13.33. Now a question. If only a minimum repayment was made each month on a balance of £500, how long do you think it would take to repay the balance completely, and how much interest would you have to pay? Now you've got 2 ways to pay. You can pay a direct debit of the minimum payment, or you can set up a standing order with a fixed amount on there. Remember, your minimum repayment will decrease along with your balance. So that's one of the things that we don't really want. You remember I outlined earlier on, that means that the credit card company will be taking longer to get your money back, which means you'll be paying more interest. Now, I don't know what you think the answer may have been to how long it would take you to repay your £500 if you only pay the minimum payment. The actual answer is quite, I think, surprising. It's almost 13 years. The total amount that you'll end up paying back is £1,071, which means the interest amount is actually more than the money that you borrowed in the first place. It's £571 on your £500 borrowing. Now, what would happen if you cancelled your direct debit and instead of having this decreasing minimum payment, you just set up your standing order for £13.33 every month and you left it there? So you did not allow it to get smaller every time your balance went down. What do you think would happen to the amount of time that it took you to repay? I think you probably all agree that it's likely to take a shorter period of time. But what is really surprising is just how much shorter. Now remember, you're not spending any more money, you're just leaving your repayment at £13.33 a month, rather than decreasing, which it would do through a direct debit. The amount of time it takes you to repay now is just 4 years and 9 months. Your total repayment amount is £749, which means your interest is less than half of what it was under the direct debit. It is now just £249. Still a lot of money, but much, much better than it would have been under the direct debit. Now I'm going to set you a little activity. If you want to do this, please feel free to pause the video after I've given you the instructions. If not, we'll just go straight through it. So I want you to check out the different times it would take to repay if you could afford to repay £20 a month. How much would the total repayment amount be and what element of that is the interest? Do the same for £30 a month if you could afford that, and again for £35. Pause the video here if you want to do that yourself. Okay, so if you choose to use the £20 a month repayment, the time taken to repay would be 2 years and 8 months. The total amount repaid, £635, and the interest element, £135, getting lower all the time because we're paying back more every month. If we could afford to repay £30 every month, it goes down again to 1 year and 8 months, with the total repayment amount now £582, which means just £82 of interest. And if we could afford £35 a month, we're down to 1 year and 5 months with a total repayment amount of £569, £69 interest. So I think the moral of the tale there is set up your standing order for a reasonable amount of money that you can afford to pay back every month without worrying about it. Your standing order means that you're never going to make a late payment, but because you're in control of the amount you're repaying, you're going to repay your debt quicker, which means you're going to end up spending less money in interest. Once you start using a credit card, make sure you keep an eye on the APR, because these things will change even with the cards that you've already got. As you get more a better credit score, you'll be open to much better deals that may be out there. And you can work out how much cheaper these things are by comparing APR with APR. Obviously, the lower APR is going to be cheaper overall. However, make sure that you check out for any hidden fees or any high interest rates, and particularly on those things, American Express use certain cards where you pay an annual fee on top of the APR. So the annual fee will give you certain rights and certain privileges, but you need to work out, is that money actually going to be worthwhile or not? So that's up for you to decide, but just make sure you check that out before you use it. If you find a deal that looks too good to be true, it probably is. So make sure that you find out everything there is to know about the deal before you sign up to the deal that you're going to use. and make sure that you look out for late payment penalties. They are expensive, not just in the cash, but also because it's going to hit your credit score. Make sure that you make all your calculations properly. Make sure you know that you've got enough cash in your account to pay your bill, your standing order that's going out every single month. It's very easy to lose track if you don't budget properly and if you don't use a spending app. So check out our sections on budgeting and also using apps to help us with our normal payments, and then we should be in a good position. So what are some of the pointers? Your student credit cards, the first credit cards you're going to get, are likely to have very high APR. That's because you don't have any record of your credit worthiness. So lenders are going to be much more careful about what they're going to lend you, and they're going to want to charge you more interest. The good news is that once you start to use your account properly, the APR will drop. Your credit limit will start out very smallly. That's no bad thing, because you're not going to be in a position whereby you're going to overspend more than you can afford. But again, provided you start to use the credit card properly and show that you can make repayments on time, then your credit limit will be increased quite quickly. But don't let that get out of your control. You're always in control. You can ask the credit card company to just ratchet it back a little bit to bring it back to the level you're comfortable with. Your minimum repayments will be high to start with for exactly the same reason as your APR is high. But one of the big benefits of buying anything with a credit card is you get something called purchase protection. That's only on items that cost you more than £100 that you buy with your credit card. But it does mean that if there's something wrong with that particular item or it gets lost, you've got an extra level of protection there. So rather than just the shop refunding you the money, the credit card company are also just as liable to refund you the money as the shop. One thing I always try and do, anytime I'm buying a holiday, I will always try and buy that on a credit card, because then I'll get purchase protection if there's a problem with the holiday company or the travel agents going forward. I've got an extra level of protection there on my holiday spend. So what are some of the risks and some of the benefits of using a credit card? Risks: you can end up spending more than you can actually afford. It's always easy to spend money on a credit card. We need to be disciplined and we need to keep track of what we're actually doing. There's a temptation to go out. Perhaps we're out for one evening, perhaps we've had one or two drinks too many. There's always a temptation to go on and spend more money than we can really afford. We can always think that this is a free source of money. It isn't. There is interest that we have to pay, and it does all have to be repaid at some point in the future. The interest rates that are going to be attached to it are also particularly high. There are cheaper ways to borrow money than using your credit card. However, a lot of credit cards will have deals and offers on there. Not maybe when you very first start up, but certainly after a year or two, you can start to increase your credit score. You can actually find 0% interest deals available on credit cards as well. You can accumulate rewards points by using credit cards to pay certain things, and those points will be able to be exchanged for money or for goods as well. Using a credit card properly is one of the most effective ways to help build your credit score, especially when you're starting at a very low base, which you will be aged 18. The credit card company offer us an extra layer of security against fraud or identity theft. If the credit card company sees something going across your account that does not look normal for you, they will query it, they will hold back that payment, and they will help protect your money. And then there is added protection for cancellations and other refund issues, which ties in with what I said just now about this purchase protection insurance that you get when you buy something to the value of more than £100. So what are some of the best tips that we would offer as advice? Always look for deals and offers before applying. These change month by month, so don't always think the deal that you start with is always going to be the best deal to have. And you can change different credit card providers over a period of time. You can pay a whole credit card balance back in one go and then open up a different one at a cheaper rate. But please make sure that you close the account with the credit card provider rather than just cutting up the credit card and not using it at all. By getting a referral where possible from somebody else that's already used it, you will get instant benefits. You will not have to build up this track record. So your referral is really key. You'll get different types of benefits. You can research those online. Just do a sort of what would happen with my NatWest credit card against the Barclays credit card. Don't think that because you bank with NatWest, you can only get a NatWest credit card. You can just as easily get a Barclays credit card. So check out all the different things through the internet and find out what the different types of benefits you can get. Try, where possible, to stay below 75% utilization of your credit score, your credit limit. This will be, again, very positive from your credit score point of view. And like I say, there is a section on credit scores whereby we'll go through all these things as well. And using it properly will increase your credit rating faster than anything else. Use your credit card as a tool that's to be used sensibly. Don't get carried away with using free money and using it on a splurge on stuff that you didn't really need. And please ensure that you pay back as much as you can reasonably afford every month on time, or better still before time, and that will ensure that you come away with a really, really good credit rating. You'll be able to utilize money that you don't have that will help you with your overall finances, and you can use your money and other people's money very successfully and use it carefully. So overall, thanks again for listening, and use all of the other 17 topics that you'll find on the website to help you build up your skills when it comes to handling personal finance. See you next time.